You see a stock drop to $50, you think that's a good price. I'm buying. You buy, the stock keeps dropping to $45, then to $40, then to $35. And a week later, the stock is back at $50. And you think, see, I was right. It came back to $50. But you're still down money. You barely break even. And you don't understand why. I'm Oli. I've been trading for 30 years and I'm going to show you why the same price doesn't mean the same trade. This is called the right side of the V. And understanding this concept will absolutely change how you think about entries. Most traders try to catch falling knives. They buy the dip, they fight the trend, and they get chopped up. The right side of the V strategy says wait for confirmation, wait for the turn, then enter when the odds are in your favor. Today, I'm going to break it down exactly what this means, why it works, and how to apply it. So let's get into it. Let me start with the fundamental concept that most traders don't understand. Same price does not equal same expected value. If you look at this chart, stock drops to $36 from $40. That's point A, the left side of the V. Then it drops to $34 and $32. Then it turns and comes back up to $36. That's point B, the right side of the V. Both times, the stock is at $36. Same price, but are they the same trade? No, absolutely not. At point A, the left side of the V, you're fighting the trend. The stock is dropping, there is no floor, there's no clear stop loss. You're hoping it will turn. Your win rate might be 55%, maybe. Your risk to reward, let's say 1-to-1. You're risking 50 cents to make 50 cents. Expected value, barely positive. You might make a little money over time, but it's marginal. Then here, at point B, the right side of the V, the stock has turned. It's made a low, it started moving back up above the EMA clouds. Now you have confirmation. Your win rate, somewhere around 70% or even 75%, because now you're trading with momentum, not against it. Your stop loss, it's clear, it's right below the recent low. You're not guessing anymore. Expected value, way higher, maybe 4 times higher than at point A. This is the difference between struggling and succeeding, between small wins and big wins. Same price, different probability, different expected value. So let's go deeper into the left side versus the right side. The left side of the V, the stock is dropping. You're thinking this is oversold, it has to bounce. Maybe you're right, maybe it does bounce. But here are the problems. One, you don't know, you don't have a clear stop. Where do you put your stop when you're catching a falling knife? You don't know where the bottom is. 2, you're fighting momentum. The stock is going down, you're betting it stops. That's a low probability bet. And 3, your risk is undefined. The stock could drop 10, 20, 30% before it turns. You don't know. I've seen traders blow up their accounts doing this. They buy the dip gets bigger, they average down, it dips more, they're stuck. And even if you're right, eventually, even if the stock does turn, you've spent days or weeks underwater watching your unrealized loss grow. You're stressed out, you're unable to sleep because on top of everything, you've leveraged your size. Is that worth it? Not to me. Now let's look at the right side of the V. The stock has dropped, it's made a low and now it's turning back up. You wait for confirmation. Maybe it breaks the prior highs high. Maybe it breaks a downtrend line. Maybe it reclaims a moving average. Whatever your signal is, you wait for it. Then you enter. Now you have a clear stop, right below the recent low. If the stock breaks below that low, you're out. No questions. Now you're trading with momentum. The stock has turned. Buyers are stepping in. You're going with the flow, you're not fighting it. And here's the best part. You can size bigger because your win rate is higher, your stop is tighter, your expected value is better. You can put on more size, risk less, and make more money. That's the power of waiting for the turn. So the obvious question is, how do you define the turn? When do you know it's the right side of the V? So here are a few methods that I use. You can use one or combine them. It depends on your style. One, break of prior bar high. The stock drops, makes a low, then the next bar breaks above the prior bar high. That's your signal. Even better if you get an engulfing pattern, that's what I like. Method number 2, break of the downtrend line. You draw a trend line connecting the lowest highs. When the price breaks above it, that's your entry. I know some of my mates using this technique. I personally don't often, but you can. And number 3, my favorite, a reclaim of the short moving average EMA cloud. When it reclaims it and holds above, that's my confirmation. Now here's the thing. Not every little bounce is the right side of the V. You need to be selective. You need to look for the best setups, the biggest move, the most extreme capitulations. If you're taking every little turn on every stock, you're going to die by 1,000 cuts. The key is to wait for the in-play stock, the ones making the biggest moves, multiple legs down, panic selling, volume surging, news catalysts, etc. Those are the setups where the right side of the V works best. Not some random stock shopping around. Be selective, wait for your pitch. Now, here's where this concept gets really powerful. It's not just about V bottoms. The core idea, same price, different expected value, applies to everything. Let's say a stock is testing out its support area. That's point A. First bounce up, then pulls back to the same support area. That's point B. Second chance to buy. Bounces again, then pulls back to the support again. That's point C. Third chance. A, B, C, all at around the same support area, but are they the same trade? Again, no. Point A, the initial test of support, that's the highest probability. The stock is supported with conviction, with volume. Volume is here, momentum is here. We see a decent bounce. Then point B, the pullback. It's okay, but it's not as good as A. The stock failed to gain distance. It's coming back to test point C, the second pullback, previous bounce, so either a lower high or a double top, the support is failing. This is not a good entry. And you see, most traders think, oh great, I get another chance to buy it. They're at the support area. But the market is telling you something. If the stock can't gain distance after the initial first bounce, that's weakness. Don't ignore it. Same thing with news event. Big headline breaks, stock jumps in pre-market, the break point on the news, that's point A. Stock opens with a gap up, then it pulls back to the breakout point, that's point B. If the stock pulls back deeply after a big news event, that's the market telling you that the news wasn't as bullish as you thought. Parabolic early action, then deep reversal is not a good sign. It means lots of profit taking, not many real buyers. Don't fight it. Don't average down. Recognize that the probabilities have changed. This is what separates the pros from the amateurs. Professionals recognize when the setup has changed. They adjust. They don't force it. So here's what we covered. 1, same price doesn't mean same expected value. The context matters. The momentum matters. The turn matters. 2, the left side of the V is fighting the trend, low win, low rate, undefined risk, emotional pain. 3, the right side of the V is trading with confirmation, higher win rate, defined risk, better expected value. And 4, this concept applies to everything. Breakouts, news events, reversals. Always ask yourself, what has changed? Look, most traders lose money because they're impatient. They can't wait for confirmation. They have to be in every single move. They fight the trend. They don't care. But the right side of the V says, wait. Let the market show you the turn. Then enter when the odds are in your favor. It's not as exciting. You won't catch the exact button, but you will win more often. You will stress less, and perhaps you'll size bigger and make more money. That's trading, not gambling. I'll see you in the next one.